Hello and welcome from Trend Signal for our review of the data and events the week beginning the 23rd of October. Another week goes by and the trend in equities remain as solid as it ever was. Outside Europe, equities are powering ahead. I think Brexit and perhaps the euro strength are a little bit of a drag here in Europe. The equity surge is not just in the US, though, which is the one that everyone tends to talk about. After this snap Japanese election that Shinzo Abe won last night, Japanese equities jumped 240 points, another 1.15%. That's the highest level since October 1996, which seems quite a heady level to have hit. But for the record, which a lot of markets seem to be focusing on records at the moment, and certainly for stock market bubbles, the Nikkei had an astonishing one of its own in the 1980s, rallying from 6,800 to a high of 37,000 by December 1989, which really set the bar for stock market bubbles. And of course, at the time, everyone said, well, it'll never go down, it's heading for 50,000, etc., etc. And, well, it's still heading for 50,000, but a lot more slow than it was at the time. But a rally of 544% in 10 years, I suspect, is now will be treated with given the sort of treatment that should be given, of course. Okay, let's have a look at the data and events this week. Despite what the calendar may look like, it's quite a busy week, really. We have, certainly for the Euro area with the ECB. We also have a bit of data actually out on Tuesday, although it's not showing on the calendar here. Forex Factory, in their wisdom, decide that it's not so important, so it gets downgraded. But we have Eurozone manufacturing and services PMI data out Tuesday. The data that we're particularly interested in is the summary data. Flash manufacturing PMI is expected to fall from those very strong numbers in September. Likewise, the services number is due to dip a little bit to 55.7. Still very, very strong numbers. Anything above 50 indicates expansion in that particular sector. So they are very, very strong numbers indeed still, albeit a little bit lower than the ones from the previous month. Wednesday, we see our own Q3 here in the UK. Gross domestic product for the third quarter that obviously ended at the end of September. It's the first reading, as prelim suggests, although you'd be confused by reading what the states call it. But it's our first reading. We're expecting a number similar to the rather slow pace in Q2, plus 0.3%. The reason why they have more than one reading is they can't collect much of the data on the first reading. Only 40% of the data is in for this first reading, and as the picture builds up, they release a second and third reading. In the afternoon, we have durable goods. The core number is what we look at. This excludes the very large ticket items such as aeroplanes. That's expected to come in line with the last month's revised number at plus 0.5%. On the Canadian side of the border, we've got the Bank of Canada monthly policy meeting as well in the afternoon on Wednesday. We're expecting the Bank of Canada, well, they've surprised us recently. Initially, we were expecting a rate rise this month, but that is not on the cards. They surprised us in July and September. There is a press conference that follows an hour and a quarter after the announcement at 4:15. There we go. So make sure that you don't just write it off when the data comes out. We then wait for comments at 4:15 our time. Regular crude oil inventories as well are also released Wednesday, the weekly data. Another drawdown in stocks expected. I'm not showing here yet, apparently, that that would be the fifth weekly drawdown in a row. Thursday is the main event for the markets. It's the European Central Bank, or ECB, monthly policy meeting. A lot has been said, a lot has been written about what Mario Draghi and the European Central Bank are going to do. The dilemma is really that the Eurozone economy continues to improve, but inflation hasn't really picked up as had been expected. Same story in the United States. The appreciation, I think, of the euro against the dollar is a big issue. That's rallied about 14% against the dollar, which offsets many of the effects on the eurozone economy in terms of its improvement, so effectively putting the brakes on the lift in economic activity is what I really wanted to say. So the dilemma really for Draghi and the ECB is to decide how to taper. If it's not in line with what the markets are expecting, then the euro will rally, equities will fall, bond markets will also fall, feeding back into equities, and that is not the desired outcome. So I think markets are expecting the European Central Bank to leave its refinancing rate and deposit rates unchanged, as that's been indicated here. They refer to as the minimum bid rate. The excitement really is around QE, which is what we've been talking about for some time now, and how much this will be tapered. Well, yeah, you might wonder why the ECB is still running a QE program, but of course they only started in 2015, so thereby hangs another tale. The ECB is buying 60 billion euros worth of sovereign bonds and corporate bonds per month. Commentators expect this to be tapered to 30 or 20 billion by 2018. Sorry, for 2018. Let's make this clear. That means the bank will continue to buy bonds, gradually reducing or tapering the amount as the program sort of peters out by the end of 2018. Then after that, as some commentators suggest, there will be rate rises to follow as well. But of course, that's a full 10 or 11 years after the Great Recession, which is the reason why it's called a Great Recession, I guess. Reading between the tea leaves, I think Mario Draghi doesn't like to upset the markets, so I expect more of a consensus move that will see the taper duration perhaps maybe extend beyond 2018, I don't know, but could start sooner, etc. But we'll wait and see. But I don't think Mario Draghi is in the mood to upset the markets. If it is more hawkish, then, as I say, that would cause the euro to rally and equities to fall, which is something that Mario Draghi, I think, doesn't want to see. Friday, we have our last key data of the week, which is the US version of the gross domestic product for Q3, like the US, but they have four, like the UK, sorry, they have four releases, though. Curiously, the first reading is called the advanced reading, ahead of the prelim reading. Bit of a confusion about the understanding of what prelim means. So they have four readings instead of our three. The other major event this week, which I can't go into too much detail on that because there are so many of them, it's the sort of mass release of third quarter earnings in the US. Out of the Standard & Poor's 500, we've got 190 of those companies releasing this week. Among the big names, Alphabet, previously known as Google, Microsoft, Amazon, Intel. They're the big tech companies that the market will be looking at very closely, bearing in mind how far tech stocks have rallied this year, and there are a whole host of other household names to boot. Of course, earnings are a key driver for the stock market, and it tends to be that expectations are downgraded ahead of the results season. So anyway, we'll have a clearer picture by the end of the week with those 190 companies releasing. So anyway, that's it. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.